Howdy, Jacob here. Today we're looking at Pacific Airport Group, which I historically did on my dividend yield screener, but in rerunning the high ROIC screener, it also popped up again here. So just reviewing these figures quick before going back over the assumptions that I set. Huge growth the last 3 years, absolutely amazing. And honestly, over the last 10 years, huge, fantastic growth. 382 million in 2014 to 1.9 billion in 2023, with gross margins down slightly, operating margins down slightly, but you're still talking about 45% operating margins. Humongous margins. Company was incorporated in 1998, headquartered in Guadalajara, Mexico. Together, subsidiaries manage and operate and develop airports in the Mexico region. So, I mean, Mexico's got a lot of growth out of them. Very novice country in relation to capital worlds and such. And I mean, return on invested capital, amazing. Return on invested capital has grown from 9% to 27% most recently, averaging in the mid-teens. It looks like. So very impressive figures here. Balance sheet shows 585 million cash on hand with not a whole lot of debt. 1.6 billion here, so there's a bit of debt there. But in relation to cash flow, let's see what that is actually. Yeah, I initially said not debt, but I was looking over here. It looks like those figures haven't been incorporated yet. So let's look at that year prior. We are looking at $1.7 billion in debt, net 1.2. So there is a bit of net debt here. And the 5-year actuary cash flow does have cash from operations growing quite a bit, but there's a heavy amount of reinvestment, which we can see through the capital expenditures growing from 43 million over tenfold to 607 million. But on the acquisition side, they've only made one acquisition. So this company is really just reinvesting back in themselves a lot, using a little bit of money as well to pay dividends. But they have been increasing that debt quite a bit. So that debt figure is not really gravitating me towards the business. I mean, it's not a huge detriment. Let's see, 5-year average, 300 million maybe. So probably more like 200 million. Let's say 200 million 5-year average free cash flow. You're looking at 8 times that. So there is a bit of debt here. Again, debt's one of those things. With a person, you could be worth $100,000, have $1 million in debt, but it's due over the next 30 years for your house. That's less concerning. But if this, 8 times debt is due in 4, 3, 2 years, that can get concerning. You're obviously they're gonna have to refinance because they can't pay it all off. And sometimes, indebtors come to you and say, hey, we need this cash now, and they can't afford it. They're gonna have to sell off some assets, which can get a little tricky and is a very complicated situation. And so although this calculation of free cash flow and earnings doesn't take into consideration debt, you will have to balance out your risk tolerance, whether that be through, better understanding when this debt is due versus incorporating a discount rate a bit higher than what your Apples or your companies that you're a bit more comfortable assuming earnings of. So to me, I thought 5% growth rate, I'd probably bump that up. I mean, they've had historically huge rates of return and growth, and I mean, they could probably grow at 8% a year. I think that's reasonable. With that, increase that P and price to free cash flow. Margin perspective, they have been going down. So I am comfortable with this 28, 25%. I don't like that the free cash flow is quite a bit lower than earnings. That also kind of upsets me. Share change, I did minus a half. I mean, they bought back a little bit of shares. 0.5% would be about 40 million a year. I mean, that seems pretty average in relation to 5-year average. Dividend, they cut in half. They're currently paying out 436 million. I'd probably cut that 67%. Say, okay, let's say they pay out about 140 million dollars. That leaves a bit more room to reinvest back in yourselves, which for a company that's growing as much as them probably makes the most sense. But I'd probably be looking for a 16% return on my money due to the fact that it's not much greater. Let's do 17.5 because they do have quite a bit of debt here. and the company is currently paying out quite a bit in their dividend, which they're funding not just through free cash flow, but also through debt issuance. And so you want companies to be able to do what they want with their cash flow to where they don't have to go to debt or issue shares to do such. I mean, that's most advantageous. If you had a 100% payout ratio between your 5 avenues, that would be perfect. But having over 100% for long periods of time can be detrimental to your business because now the company's in way more debt than they were 10 years ago. Their debt is now 1.6 billion. It used to be less than 100 million just 8 years ago. And so they can see that although they've increased the business quite a lot, and they really have, their cash flow is growing, their earnings are growing, everything's really growing. But now they're in a worse situation from a debt standpoint to where, people might just be turned off by this debt. And so this would definitely be something, even before, I do more research on it, or when I do more research on it, I definitely want to take a look at that debt. And then obviously, these are high growth figures for a company that is outside the U.S. So you definitely want to be comfortable with the figures and everything. But to me, I think the debt is probably the biggest thing that scares me a little bit. But the business itself growing like crazy, great margins. I think there's a lot of opportunity to grow in Mexico, but it's just not at that price yet. So hopefully you enjoy the video. Have a great rest of your day. Thank you.